So I did it. I earned the Financial Risk Manager certification for the Global Association of Risk Professionals. I sought out this credential wanting to level up as a crypto and blockchain professional, and I had to pass two separate, highly technical 4-hour exams set 6 months apart. Let me tell you, even with a master's and a CFA behind me, it was still a lot of work. Last time, we looked at whether the FRM exam could be worth your precious time if you work in blockchain or crypto. Today, we're going to spend more time looking at the actual syllabus content and how it relates to crypto. I'll have most to say about the section of the syllabus that deals with liquidity risk and treasury management. That's where I think the most valuable content is, and I've put timestamps all the way through the video to help you navigate to the sections you are most interested in. The FRM syllabus is grouped into two parts, each of which has their own exam, Part 1 and Part 2. The syllabus does change slightly every year, but not by that much, so I bet that this review will still give you a good sense of what's in store for the next 2 or 3 years at least. These books are pretty chunky. I'm holding up the Part 2 books over here. I am not going to have much to say about Part 1. If I'm honest with you, Part 1 was the part of the syllabus that had me intensely asking myself, what the hell am I doing? It has a lot of broad and foundational topics in finance, but without going deep enough to make you feel like you're learning anything that could be transferred anywhere else. Just to glance through it briefly, you've got these general areas covered. Much of this stuff I'd seen in my university studies or the CFA and didn't feel like it penetrated very far into risk management beyond what I might have been able to think about for myself with the knowledge I already had. So you can see I'm not sugarcoating this review or anything or trying to suck up to anybody. I was not enthused about Part 1, and I really doubted its value to me. But for better or worse, though, I am a very stubborn individual, and I followed through with it and thankfully passed. All this stuff that made the FRM interesting and thought-provoking for me was in Part 2. But as I've said in the other FRM video, being able to apply this material to crypto has required me to make connections for myself by exercising some extra intellectual imagination. But in the meantime, to get qualified, you have to train to pass a test that is narrowly focused on TradFi applications, just like Part 1. Okay, so let's kick off with liquidity and treasury risk measurement and management. You can see all the book chapters on screen now. Although it's not the first book of the Part 2 syllabus, I've decided that I'm going to kick off with this because I know that some of you are going to stop watching this video, but I'd hope that you'd at least stay to make it through this section because this is the area where I have most to talk about and was without a doubt the most important and valuable part of this FRM adventure for me. This is the area which prior to these studies, I felt I had the biggest blind spot and yet which was very important to the kind of advisory service I wanted to deliver for my clients. So to explain, prior to working in crypto, I specialized in a corporate finance style of financial modeling, one where you use spreadsheet software to represent how a business generates cash, what happens to it, and express that in the language of financial accounting. You use this analysis to help a company get hold of external financing or help it to manage its internal financial resources better, plan for its future, and so on. Now, some of these models can be extremely large and complex, and I know because I've built them, but the modeling that you need to perform ultimately remains bounded by some commonplace facts about how typical businesses operate. For most businesses, cash is the only financial resource that they have to manage. Most businesses do not carry cash balances that are large enough to support complex treasury management activities. Most businesses only operate in one jurisdiction and only deal with one currency for all their ingoings and outgoings. And for the most part, cash is a stable value asset, and its value inside of its own currency area is not defined by trading in financial markets. And furthermore, most companies do not have to think about public financial markets unless they decide to go public or issue publicly traded bonds. And that only typically happens when they are large, settled businesses that can afford to pay for sophisticated internal finance team hires and to bring on external advisors to support the process as well. Now, blockchain businesses couldn't be more different. Most have to manage more than one significant financial resource, cash plus their own digital assets, sometimes more than one of them. The current paradigm in token financing includes endowing the project with a large treasury of their own native assets, and sometimes that morphs into them having to manage a large fiat treasury too. Depending on how the token economy, revenue, and cost processes are set up, some value flows are going to be in fiat and others are going to be in native token. The value of your token is largely going to be decided in open financial markets that, by their own nature and due to the nature of typical crypto assets, are extremely volatile. And finally, you're going to be listed and trading in these markets extremely early on in your business development. So you see, I was deeply expert to perform financial analysis for businesses that fit this typical profile, and no small thing, because I've used those skills to help bag deals worth hundreds of millions of US dollars. And while all these tools, methods, and insights continue to be relevant to crypto insofar as they pertain to cash management, there are now also lots of other material variables that need to be taken into account, which I did not feel equipped to handle to the same professional standard. But don't I already have the CFA? Didn't that teach me what I needed to know? Well, no. The CFA syllabus does cover financial markets, but really just telling you a bit about how they work, some of the strategies that traders use, the general role they play in helping companies source debt and equity capital. But most significantly, all of this stuff is taught from the perspective of how you make and manage investments, which is mostly concerned with upside. This chapter of the FRM, on the other hand, has a completely different emphasis. We really go into the details of how you interact and interface with public markets as a way of managing financial resources that support some kind of financial operation, with careful attention to how you limit downside risks. And that involves a totally different set of analyses and techniques. And that explains why I was so interested in this book, and thankfully, it really did not disappoint. Now, I'm under no illusions. Reading this material does not instantly make me an expert treasury manager, but I do think that this knowledge has improved my ability to think clearly, critically, and in an informed way about these issues, and will improve my problem solving and my ability to tend to these critical issues in my work. So let's look at some of these contents in greater detail in this book. We kick off with liquidity risk. Lots of really interesting stuff. We look at an extension of the value at risk metric called liquidity adjusted value at risk. That's something which I see having very precise and clear potential for application in the analysis of decentralized exchanges, where there is a clear mathematical relationship between liquidity and pricing. There's some content that chimes with material that you see in some tokenomics discussion around agent-driven simulations, which explores how trading behaviors can create feedback that creates vicious cycles that suck out liquidity from markets, and what kind of trading behaviors or dynamics offset or stabilize those kind of dynamics. You also get a look at how you unwind positions optimally to mitigate liquidity-related impacts. Really important stuff for a project treasury that's trying to assess and plan how to liquidate a position to cover operational expenses or fund some exceptional items. And then you get a look at how liquidity risks emerge and manifest through the process of maturity transformation. So this is really relevant to traditional banking, which takes in savings deposits that users can claim at any time in order to fund longer dated loans that will take a longer time to repay and mature. This may appear most relevant to credit-related crypto services, but again, as we deal with crypto instruments that can be programmed in very complex ways, these issues around maturity transformation and maturity mismatch are going to emerge as an important part, an important consideration when we think about how we create a resilient token economy design and how to manage it in that way. We also have a section on early warning indicators. This offers insight into thinking about what kind of indicators you could find for your crypto economy and how you would set those up, how you can set appropriate safety thresholds for these warnings. We've got a section looking at how you create, size, and manage liquidity reserves. Again, this seems super relevant to crypto. If you're going to hold a reserve, you better make sure that those assets are not being put to work in some other kind of way. How do you size that reserve correctly to adequately cover the risks that you intend to without going too far? How should it be managed? Then you got intraday liquidity risk management. This chapter I found fascinating because it discusses a whole range of problems and techniques for addressing them in traditional finance that I think are just going to be made entirely obsolete by blockchain technology and similar advanced digital finance technologies. It relates to all these uncertainties around the availability of liquidity in a given day and being able to respond at short notice. Blockchain technology is going to give us much better granular real-time data visibility in this area, which is going to empower our ability to manage all these sorts of issues and be more responsive about them as well. So I felt like the material in this chapter and all the workarounds and compromises it teaches you are going to be superseded within the next decade. Finally, you got some chapters on monitoring liquidity stress testing and reporting and contingency planning, which again furnishes you with a library of resources and techniques that you may want to draw on to improve your liquidity planning and downside analysis for your project. This includes assessing and understanding how different claimants and sources of liquidity are likely to behave under different circumstances. And then you get into all this stuff around conventional deposit services, which I think is also interesting and has some crypto crossover. Crypto projects are not, for the most part, acting as simple depository institutions, but in a lot of cases, we are still creating systems that use staking, for example, which allows users to have some kind of short-term claim on a token. And in some cases, that token is being put to work in other areas of a token economy. So I can see how some of this thinking would transfer over to similar situations about how staking services ought to be costed or how we value staking rewards. Again, this chapter is also interesting because it has a lot of content related to traditional depository banking, which I think is going to be totally disrupted by blockchain technology. Then you have a section that looks at different sources of liquidity, non-deposit liabilities, borrowing from the central bank, commercial paper, large certificates of deposit, repos. And I think what really stood out to me from this material was getting this much more detailed understanding of just how much more complex and sophisticated the plumbing of the traditional financial system is. There are all kinds of financial instruments, agents, and players who are able to shuttle liquidity around the system at short notice. We have nothing like that in crypto at the moment. There is no central bank. There are no large banks or short-term credit markets that step in to offer liquidity relief at short notice. There's no large asset base of high-quality yield-bearing assets like US Treasuries that can be offered up as collateral for a short-term loan. So if we look at a crypto startup by comparison, the entire financial risk management burden basically sits on them. They do not have access to these products and institutions or an asset base that give them this extra flexibility that they might otherwise need to survive and be more flexible and dynamic. And again, I think this gives us important insights into service gaps and ecosystem niches that remain available for the taking in crypto. We're going to see some very large and important businesses come to serve them in the future as this industry matures. We'll also take a look at liquidity transfer pricing, which examines how we charge the availability of liquidity within an institution once it's available so it can be allocated efficiently from an economic standpoint. That's something that could be useful to a crypto enterprise that has multiple competing uses for liquid capital. And after that, there's some stuff on international demand for the US dollar and examination of what happened in times of stress, stuff that could be peripherally relevant to the evolution of stablecoin markets, which do effectively represent an extrajudicial issuance of US dollars, and also some other topics around currency exchange markets, asset liability matching, and illiquid assets. So yes, all of this makes for a really stimulating book in the FRM syllabus. I found it very worthwhile for sure. Next up, we have market risk measurement and management. Here's where we really dive into value at risk much more substantially than in part one, as well as other topics like expected shortfall, other techniques and approaches for measuring tail risks like extreme value theory, parametric and non-parametric approaches to risk estimation, backtesting, methods for estimating correlations, risk factors, and other topics for bonds and options that you see on the screen now. Unlike the quant syllabus in part one, I did feel that this content brought me into newer territory, and I felt like it was deeper and more meaningfully practical than the quant stuff in part one. This material covers a substantial range of quantitative techniques that were familiar to me already or modest extensions over things I'd already studied. So I do feel comfortable applying some of the things in this chapter. And by studying this material, I've gained a large reference library of resources and the ability to know where to go looking at how to make sense of them when I need a tool that's not currently in my toolkit. Next up, we have credit risk and management. All the book chapters are on screen there if you want to pause here. My expectations at first was that this book was not going to be very interesting and relevant to me. I guess that was a fair guess for this first half of the book, which covers fundamental stuff about credit risk assessment, how it's managed in banks, estimated default probabilities, credit scoring. But once we move past that, there's actually a good deal of material that is much more interesting and relevant to crypto than I was expecting. You go deep into the mechanics of all these complex instruments which blew up the financial sector in 2008, like collateralized debt obligations or even CDOs squared, which I now have the satisfaction of having been able to understand for some fleeting moment in my life. You also get to study securitization and structured credit risk more generally. So why did these areas stand out to me as someone who is focused on blockchain, in particular issues concerning token design and token economy design? Well, essentially it comes down to the programmability of blockchain assets and smart contracts and the potential which that represents. All these complex credit products in the traditional financial sector are just bundles of rules. We rely on business norms and operations and legal force to execute them in a way such that the contingent value transfers occur as intended. And in some cases, we saw that our efforts to contrive these clever contraptions really did blow up spectacularly. Blockchain technology opens the door to structuring and securitization on steroids. Putting regulations aside to 1 second, we can go as crazy as we want, programming in layers and layers and layers of rules, restaking tokens that allow us to maintain financial liquidity over an asset that is exposed to risk somewhere else in the system, restaking them again. We're going to see structured credit tokens soon. So getting a look into how some of these instruments work in TradFi in fine detail and understand some of the risks that they pose is all going to be very informative for crypto, even if we don't see the exact same instruments and products in the ecosystem at this point. So all this material was really cool for sure. And then we have this other block of topics in the book that talk about counterparty risks, how they can be mitigated using margining and settlement requirements, as well as central market clearing institutions and infrastructure, methods like CVA and DVA for quantifying counterparty risk. Again, because crypto tokens have this potential to represent some very dense and complex claims on value, having awareness of the role of counterparty risk, how to measure it, I think is all going to be relevant. Even if we aren't seeing these issues being handled or dealt with much sophistication in crypto at present, I think it sets you up to stay ahead of the curve and be aware for when these risks are going to need to be taken into account and the methods and tools that are available to you. It also just gets you thinking a little more sharply about how crypto asset markets are set up and what kind of risk gaps remain that should be addressed in larger and more mature financial markets. So I got a lot more out of this book than I expected. Next up, we have operational risk and resilience. As with credit risk, my initial expectations were that this book was not going to be heavily of interest, but in the end, it contained a lot of topics which were and which have transferable relevance. The first part of the book looks at frameworks for identifying operational risk and setting up systems for risk management within an organization. Now, reading a few chapters here and there does not equip you to automatically set up a risk function in an organization, but it tells you how these things are being done at the best institutions that have the most financial capital at stake. And maybe that is good enough to help you spot some major flaws or blind spots that could use correcting at your startup. Then we have a section on cyber risks, which was interesting, if ultimately only as an introduction aimed at building awareness around these issues. Despite all the cryptography in crypto, these issues still very much are relevant. So I felt an interest in learning a little more about how these issues present in TradFi context and how they're managed. Pretty closely related in a crypto context is the issue of financial crime and fraud. Understanding the importance and seriousness of these issues helps you understand why we're seeing this gradual curtailment of pseudonymous and permissionless solutions in blockchain. Third-party risk management is also relevant. Crypto involves you with working with lots of outside third parties like smart contract auditors, consultants, launchpads, market makers, exchanges. Having a sense of risk management practices when dealing with these third-party relationships, again, interesting, super relevant. The area that I definitely slowed my reading down for taking lots of notes on was this section on model risk and validation. A key feature of what I offer clients is advice that's grounded in quantitative modeling. But where modeling best practices are pretty settled and well-defined in a lot of other financial areas, they remain a much more open and at times ambiguous problem in crypto contexts. So I found this section really interesting, diving deep into specific risks that arise when you develop and work with quantitative models and how to avoid these classic perennial traps of thinking that just because you built a tool that's mathematically sophisticated, that this somehow guarantees some kind of truthful bearing on the problem at hand. And there's also plenty of stuff about what you need to do after to make sure that your model continues to remain informative, really relevant stuff if you're doing modeling work for yourselves. A lot of this goes beyond the resources that you're going to have at a startup or a boutique consultancy, but having some sense of where the bar is set at the biggest financial institutions is definitely going to be helpful to you. You're also taught about methodologies for evaluating the return on capital that you set aside to absorb risks. Are really interesting to ensure that you don't over or under allocate capital to these areas. And then you have a detailed historic look at regulations in the financial sector, Basel 1, 2, 3, why they were created, why they were changed, and so on. I think that this stuff is very helpful to get out of this adversarial mindset with regulators. A lot of us in crypto are excited that we have this freedom to do anything we want to with this censorship-resistant technology, and we don't have to pay attention to all those boomer fuddy-duddy dinosaurs stuck back in the past. But actually, even if the regulations aren't perfect, they are a response to real problems and crises that have occurred that created a lot of damage and pain for people. And we really do run the risk of repeating the same mistakes if we dismiss the experience and history of traditional finance as irrelevant, finally saying that the old rules just don't apply. In order to have a constructive conversation, we need to understand what the concerns of regulators are and how big the gap is between what banks and regulated institutions have to do and where crypto sits today. So even though in practice, a lot of this material just turns into memorizing facts and rules for the exam, the reading behind them, I think, is super interesting and helps give you more understanding about the role that regulations are going to play in the future of the crypto industry. The last book is one on risk management and investment management. Let's just say here, for me, much of this material was closer to stuff that was familiar to me from the CFA, but with some meaningful extensions. You look at how to apply value risk in portfolio management and some issues around how you choose an appropriate benchmark to evaluate yourself against and how that impacts your results and your estimation of alpha. But unless you're managing multi-asset crypto portfolios exclusively for investment ends, I think this material is less relevant. Some stuff on hedge funds, how to do diligence on them, ways to predict fraud. I found it interesting, but only incidentally. And so that's all the books, but actually the Part 2 syllabus also has an added set of reading requirements that get changed each year. They form a minor part of the assessment, but let's still check in here for completeness. You have a section on climate risk, which includes publications by the Bank of International Settlements. I happen to find this interesting because I used to work in renewable energy, but that's just me, obviously. You have some materials on AI and emerging risks around this technology. I definitely found these readings of interest. And if you're interested in blockchain technology, I'm pretty sure you'll be interested in them too, and we'll find some natural motivation to enjoy them. There's a look at new risks that are emerging as finance becomes increasingly digitized, more fast moving. Maybe this creates a need to create circuit breakers, different approaches to risk management and control that need to be implemented as a result. Stuff that I can definitely see being relevant to crypto as well. And then we have some stuff that is definitely directly relevant to crypto. We have readings on two major bank failures in 2023, that of Credit Suisse and that of Silicon Valley Bank, which, as many of you know, triggered a depeg and loss of confidence in USDC, exposing major custodial risks for that project that they've been working hard to repair since. And I definitely got a lot out of this reading. That paper comes directly from the Fed itself. So directly from the source, not from some conspiracy theory-minded YouTuber. And yes, you do actually get a reading that is directly about crypto and blockchain as well. A lot of the stuff here was familiar to me, but this reading comes from the grand source of all financial evil, if you believe some YouTubers, which is the BIS, the Bank of International Settlements. And I'm being completely ironic in case that needed saying. I don't believe that this world is run by puppet masters. I've actually read a number of papers from the BIS on blockchain, and I'm always left with a similar feeling that its analyses of the issues are technically astute and sophisticated, but somehow they're always done in bad faith, focusing on the worst, most corrupt examples of the technology, or drawing the most pessimistic conclusions about their analysis. But with each new paper that they publish, they do see some marginal inch to the industry. In the paper you have to read for the FRM, the author is begrudgingly accepting that there are some real and substantive innovations in DeFi, but at the same time dismissing it as fundamentally flawed in other ways, and that these toys will be better handled by adults in the room who have more experience and can do it better. I may not believe that the BIS is a conniving puppet master, but yes, I do think that they are biased in their appraisal of this technology, but they are engaging with it and working on some really cool projects with established major financial institutions that they publish on periodically. So I happily keep the BIS on my reading list. And with that, we're finally at the end. I have no idea how many of you are still watching. If you're still here and want to encourage me with what I'm doing, do take a second to leave your favorite emoji in the comment section. It's a lonely life making these super niche videos. I only did this one because I talked myself into thinking that it would be a good exercise to document and integrate the key points that I've learned from this journey. But of course, I will be delighted if it also ends up helping some of you out there as well. Bye for now.